Hi everyone, hope this video finds you well. This is the first video for chapter 12 for inventories. Um, we'll do another video or set of videos for the second part of inventories, which will be for the next class. So just a reminder of where we're at. We're working through the stages of an audit. We have our 6 stages of the audit, and we are focused on there we go, on these middle 3 uh, in terms of how they apply to each of these different transaction cycles that we are looking at. We looked at cash already, we looked at revenue, and now today we're looking at inventory. So still the same 3 stages of the audit. We're just going to see how does it apply to inventories and cost of goods sold. So we have our 6 learning objectives. These should start looking pretty familiar for each of the transaction cycles. They're largely the same. Occasionally you'll see some tweaks, but they usually start off with describing kind of the nature of the transaction we're focused on, then moving to the second objective, which I'm going to just specifically focus on describing the audit objectives for inventories and cost of goods sold. Then learning objective 3 and 5 I'm going to pair together because they're essentially understand the process, understand the controls over the process, and then how will we go about obtaining an understanding of the internal controls as the auditor. So learning objective 5 is from the auditor perspective. And then learning objective 4 is about assessing inherent risks related to the transaction cycle. And then step 6 is where the meat of most of, or really where most of the substance of, what audit procedures are we going to actually do, how are we going to manage detection risk is going to be in learning objective 6. So if we look at the first learning objective, describe the nature of inventory and cost of goods sold. You all largely understand inventories and where they come from. If we're talking about a retail firm, then what goods are on hand ready for sale is kind of mainly what you have. And then you might have kind of supplies inventory if you're just a regular retailer. But then if we're a manufacturing firm, or if we're auditing a manufacturing firm, then they're also going to have work in process, right, which is the second item. And then they're going to have raw materials as well. And those would be in addition to what they would call finished goods, right, which is just the first line item. So I think that's largely straightforward. Just a little reminder of the journal entries. I like to kind of start with journal entries. Well, I'll start with the nature of the transaction and then think about journal entries because this is where you've kind of lived before. So if you think about the 3 inventory accounts for a manufacturing firm, you have raw materials, work in process, and finished goods. And the question is, how would the journal entries fill in for the inventory process? So this is where I normally would ask questions of the class, but since we're doing this virtually, if you want to pause for a minute and then think about what are the debits and credits related to the different journal entries for this process. Okay, so assuming you've done that, or assuming you don't want to do it, if we look at the items that are actually in each of these, if you look at raw materials, we have purchases, debit to purchases, increasing the balance, and then obviously we'd have an accounts payable as the credit there. But if we're focused on inventory for a minute, then we have, when we're using the direct materials and then bring them into the work in process, we're going to debit work in process and credit raw materials, right, for that amount that was used. And then for work in process, in addition to direct materials, we're also using direct labor, right? So as labor is being applied, then that's going to increase work in process, and then it's going to credit, right, essentially a payable as far as like salaries or wages payable. And then we're also going to have overhead, which, remember, that's overhead is allocated, right? And so you'd have a separate overhead account that's going to be accumulating indirect materials, indirect labor, other manufacturing overhead, and then it's allocated using some allocation method, which you learned in your cost class, right? Whether it's activity-based costing or very simple ways using direct labor or direct materials or something like that. Um, but obviously, you can get more sophisticated, machine hours, and then obviously activity-based costing, like I said, would be kind of taking that a step further. So we're not going to focus on that, but just recognize that there's an allocation method that does that. And then as we're finishing the manufacturing process, then we're going to move not just the materials from work in process to finished goods, but also we're going to increase finished goods and decrease work in process for the amount of cost of goods manufactured. And so then when you're looking in the finished goods account, as we're making sales, right, um, debiting, excuse me, um, we're going to have a transaction with making a sale, and ultimately we're going to have to reduce cost of goods sold based on what was sold. Now, this is still a very simplified approach. To be more realistic, cost of goods sold in terms of how we get the allocation for what goes into cost of goods sold versus what is going to stay in the balance of finished goods. That's where you're going to have the inventory valuation methods like LIFO and FIFO, right? That determines kind of the flow in terms of how you're going to apply the cost in the process. And another wrinkle would be you might use standard cost, like a standard costing method, if you remember from your cost class, for direct materials or direct labor, right? So that may be as the batches are moving through the manufacturing process, that might be how the costs are initially allocated. Now, obviously, if you have variances, right, in terms of the actuals are different from the standard costing you're using, then those variances have to ultimately roll into work in process and cost of goods sold. And so again, there's still some more complexity to this process than what we're even suggesting at this point. And so, inventories are significant for a decent number of firms. Not every firm. For a decent number of firms, though, it is a material amount relative to the balance sheet. It often can be the largest current asset of a company. Again, if we're talking about retailers or manufacturers, definitely the case. And oftentimes, if you can overstate inventories as managers, then you can manipulate earnings, right? And so, oftentimes that might be done um, in an attempt to make the company look better, right? As far as having higher earnings because of a lower cost of goods sold. And looking at one case from the history of the U.S., this McKesson and Robbins was a significant fraud case back in the 30s. And obviously, these are small numbers today, but 80 something years ago, having $10 million in non-existent inventories was a pretty large amount. And just looking at, they had 19 million in fictitious assets as well. So these were substantial numbers back then, and it kind of caught the public off guard. Essentially, the auditors had followed standard practice at the time, which was only looking at the accounting records to say how much is inventory. They didn't actually do a physical or an observation of the physical inventories, and so that's something that led to some, at that time, the profession regulating and requiring now that auditors actually observe physical inventories. And as we'll see when we get to the substantive testing later, this is going to be one of the big tests that we're going to do. But obviously, this can be the point of this case is just to kind of bring out that inventories can have a significant impact on a firm's financial statements. And in an attempt to make these videos a little more consumable, I'm going to stop here for this video, and then I'll add another one for the next learning objective or set of learning objectives.